Fubo TV is set to report earnings on November 7th. The stock is up over 109% in the past year, but it's still down 72% in the past 5 years. In this video, we'll take a deep dive into the fundamentals, run a discounted cash flow model to estimate the intrinsic value and potential future returns, and discuss the possible merger with Disney, which could completely change the company's outlook. Starting with their financials, Fubo's revenue has grown tremendously since going public 5 years ago, jumping from $217 million to $1.6 billion today. However, that growth rate has started to slow down recently. Analysts expect revenue to increase from $1.59 billion this year to $1.86 billion by 2027, which represents a noticeable deceleration. Regarding profitability, Fubo just turned profitable this year, and they are currently making $89 million in net income. What's even more impressive is that their free cash flow is even higher, currently sitting at $143 million. These numbers mean that the company is trading at a P of 13 and price to free cash flow of 8, both of which look quite attractive for a company that might still have significant growth potential. But to take a deeper look at the valuation and estimate potential returns, I ran a discounted cash flow analysis using my Google Sheet model. Here's what it shows. If you bought the stock today at $3.6 per share, your annualized return over the next 7 years would be roughly 5% according to my low scenario, 23.5% in the base or mid scenario, and 38% in the high scenario. So huge returns according to my middle and high assumptions. And as far as my assumptions, I assumed Fubo grows revenue between 3 and 9% annually for the next 7 years, the average profit margin and free cash flow margin between 4 and 12%. This is the hard part about valuing the company because they just turned profitable. But because they have a 16% gross margin, I believe this is achievable. And I also assigned a P/E price to free cash flow at the end of the 7 years of 16, 18, and 20. But if you want to make your own assumptions, I've left a link to the spreadsheet in the description. It's very easy to use. I've already set up all the formulas, so you just need to input your own numbers. Moreover, Fubo's balance sheet is also in decent shape. They currently have about $283 million in cash and $375 million in debt, a manageable level considering their $1.23 billion market cap. In my opinion, even if the merger with Disney doesn't go through, Fubo could still be a good investment, as long as you believe in their product and their long-term vision. That said, there's still a lot of uncertainty surrounding the company's future, especially given how competitive the streaming and live TV space is. Now let's talk about the potential Disney merger and how it could completely transform Fubo TV's future. On January 6, 2025, Disney announced plans to merge Hulu plus live TV into Fubo TV. Here's how the structure of the deal looks. Disney will own 70% of the combined company. Fubo shareholders will collectively retain the remaining 30% ownership. Fubo's current management team will continue to run the platform, and initially both Hulu, Live TV, and Fubo TV will remain available as separate services for subscribers. So if you invest in Fubo TV today and the merger goes through, you're essentially buying into 30% of the combined Hulu plus Fubo entity, a brand new streaming powerhouse. Together, the merged company would have around 6 million subscribers, combining Hulu Live's 4.4/4.5 million users with Fubo 1.3/1.5. That would make it the second larger internet pay TV provider in North America, just behind YouTube TV. Financially, the merged operation is projected to generate around $6 billion in annual revenue, compared to Fubo's current $1.5 billion. Disney's majority stake gives Fubo the backing of one of the world's biggest media giants, plus access to premium content, including ESPN, ABC, and other top-tier networks, which would strengthen Fubo's sports-centric lineup and make it a much more competitive player in the live TV market. It's important to note that, at least for now, Hulu plus Live TV and Fubo TV will continue to operate independently. Hulu subscribers won't automatically be switched to a Hulu-Fubo combo. Over time, Disney and Fubo might decide to bundle or rebrand the services, but there are no immediate plans to merge them into a single subscription yet. Another major benefit of this merger is the improvement to Fubo's balance sheet. Before the deal, Fubo actually had ongoing litigation against Disney. As part of this agreement, Fubo agreed to drop the lawsuit, and in return, Disney will pay a $220 million cash settlement to Fubo. On top of that, Disney also committed to providing a $145 million term loan in 2026, which gives Fubo extra financial flexibility and a stronger capital position moving forward. Overall, I think Fubo TV would benefit significantly from this merger. If the deal goes through, the stock price would likely surge given the stronger balance sheet, new growth opportunities, and Disney's powerful media ecosystem. That said, there's still a lot of uncertainty surrounding the deal and the long-term direction of the combined company. So in my opinion, it might make sense to take a small speculative position if you believe in Fubo's product and the future of live streaming. Personally, I'm staying on the sidelines for now, but I completely understand why some investors would want to get in early, given the upside potential. Lastly, if you want a discount on stockanalysis.com, the best site I found for stock data, grab my code in the description. I hope you found this video valuable. Let me know what you think about Fubo TV stock in the comments, and I'll see you in the next one.